So how is it that it's easier for your employees to get a mortgage than it is for you to get a mortgage as a business owner? Let me explain to you because it makes sense, although it really isn't fair. Now, I know life's not fair, but let's be honest. This is one that really sucks. But let me explain to you what's going on. It has to do with proving your future earnings and your ability to consistently repay the mortgage. There's three things mortgage companies care about when it comes to qualifying you. It's your cash, how much you have for down payment and closing costs. It's your credit, how well you paid your bills in the past, because that's the best indicator of how well you're going to pay in the future. And then your income. No matter how big your down payment, no matter how good your credit score is, if you don't have enough dollars coming in to make your payment, then you won't be successful in paying the mortgage. That all came about in 2011 after the crash of the financial markets in 2007 and 8. The financial reform bill called the Dodd-Frank Reform Act said, look, we got to prove that everybody has the ability to repay. And poof, overnight, it became really, really hard to qualify as a business owner. So let me explain to you what's going on. Your employees, even though there's no such thing as a guarantee of a job, they have a skill that's transferable that if you laid them off or you fired them, they could probably go somewhere else and make a similar amount of pay. So the market is open to replacing their job with another job. They could find a different job with a skill that gives them a similar amount of pay. So when we look at how much money they're making, their pay is typically a predictable, stable amount of money. It's an hourly amount, it's a monthly salary, it's an annual salary. 9 times out of 10, we can easily predict their pay going forward. For you, not so simple. What we have to look at for you is how has your business operated for the last 2 years? And how do we apply that to how the business is going to operate for the next 3? It's that simple. We're looking backwards 2, and we're looking forwards 3. But here's the catch-22. It's about the type of loan that you get. If the loan that you are getting is backed by the federal government, Fannie Mae, Freddie Mac, FHA, VA, guess what? The federal government wants to make sure you're paying your share of taxes. And we can argue about what is your share of taxes. My point is the government says, look, if you're not reporting it to us as profit through the IRS, we're not going to let you count it as profit for your qualification of a mortgage. It's that simple. Now, there's ways that we can look at 1 year tax returns instead of 2. I'm going to have other videos on my channel that'll talk about that you can search for. But the bottom line is that it really comes down to what are you showing in profits. Now, we add some things back in there. I'll go into more detail in other videos on that. But the point is it's all about your tax returns, and we're trying to predict the future. Now, if you're any good at running your business, you understand you don't want to pay your silent partner, Uncle Sam, more money than you need to. So you probably have a good CPA, and that CPA lowers your profit legally, using some loopholes, using not loopholes. The fact is there are risks that you take as a business owner, and you rightfully have the ability to reap rewards by paying less in taxes. But it makes your income less stable and less predictable. That is the root of the challenge of being self-employed, is that your future earnings depend on decisions that you are making. Many business owners, the business can fail, and you can't just replace that income by going to work for somebody else. So it's not as simple for you to qualify it is for your staff. So I've got lots of videos that go into all of the different ways that we can qualify you. We can look at bank statements. We can look at your profit and loss report. Lots of different things that we can do to help simplify how to qualify you, but those come at a cost. They're either going to be a higher interest rate, a bigger down payment, more in fees, or all of the above. You're almost always going to get your best deal getting money from the federal government. But is it worth the trade-off? Is it worth paying more in taxes to the IRS just to save a little bit in interest, which, by the way, the interest is tax deductible. So think twice before you move forward with filing your taxes at a higher profit amount just to qualify for a mortgage today or potentially sometime in the future. There are alternatives, and I want to help guide you through those. So subscribe to my channel if you haven't subscribed already. Check out my other videos, and I look forward to being your guide through qualifying for a mortgage and all of your mortgage needs as a self-employed person.